Welcome back. Well, let's put spotlight on Cyient DLM as promised earlier. It is in focus today ahead of their IPO that is opening next week. The offer opens for subscription on June 27th. Earlier today, the company said the issue size of the IPO has been reduced to 592 crore rupees, which is versus an expectation of 700 crore rupees earlier. And the price band has been set at 250 to 265 rupees per share. The EMS opportunity looks very exciting because of the way EMS players have performed in Q4. To understand the business and a lot more, Krishna Bodanapu, who's the chairman at Cyient DLM, is joining us now to discuss the business and tell us more about this opportunity as well. Mr. Bodanapu, good afternoon. Thank you so much for joining us. Well, it's a 592 crore rupee of fresh issue. Talk to us about how will this money be used? What will the promoter holding look like after this fresh issue? And what is the debt looking like in the books?
Thank you very much for this opportunity. I just want to quickly highlight that Cyient DLM has some very unique opportunities in front of us. We are primarily in the low volume, high precision manufacturing for electronics, for aerospace, defense, medical kind of industries. So with that context, we see some very, very significant potential for growth. And therefore, the idea behind raising this fresh capital is to fund that growth. 100% of the proceeds are primary, so they will go into Cyient DLM and primarily used for three things. The first is we will use it to pay down some external debt because we believe it's an opportunity to optimize our finance cost and cost structure. The second is we will use this for working capital for the next 3 years. Again, there is a lot of growth ahead of us and we will require the working capital. And the third is to make investments into, again, facilitating the future growth, be it with sales and other expenses or technology, and also one or two small acquisitions that will help us plug the capability and the capability gap that we primarily have. So that would be the use of the funds. In terms of the holding of the promoter, in which case this is Cyient Limited, Cyient Limited will hold about 2/3 of the company based on the higher end of the band for the pricing post the issue.
And you will be debt-free in Cyient DLM after this fresh issue?
We will be debt-free from any external perspective. There is still going to be some debt from the promoter, Cyient, in Cyient DLM, and that we will only pay out from the cash that the operations generates over the next few years.
And how much would that be, Mr. Bodanapu?
It's roughly 200 crores or so is the additional debt that's also there.
Okay, 200 crore rupees. Well, you spoke about growth opportunities in the EMS space. You spoke about it being a low volume but high margin business as well, or the opportunities in aerospace or defense. What is the order book split looking like? You do have defense, you do have aerospace. Can you split that for us? How much is coming from exports? And is export a better opportunity in terms of margins than domestic markets?
So right now, the four industries that we focus on, which is aerospace, defense, medical, and industrial, because this is where we see the opportunity for the high precision and high value-added manufacturing. The order book is pretty evenly split across the four. I would say that aerospace is a little bit higher, medical a little bit lower, but all within a certain range. The exports are about 70% today, 65 to 70% depending on the quarter. And we believe that there's a good balance between exports and India business. One of the reasons why we're seeing the growth that we're seeing and the opportunity that we're seeing is also because India is coming to its own as a market, and there's a lot of indigenous production, indigenous design, and indigenous need that is there because of some of the imperatives that the government has put in place and some of the encouraging things that the government is doing. So we believe that this 65% exports, 35% Indian market will continue, and that's a good place for us to be. We actually make, basis the work that we do and basis the value add, we make similar margins in India and non-India business, so we will continue to focus more from the perspective of having the right portfolio and mitigating risk rather than from a margin perspective.
Okay, all right. So margins are same both in the export and domestic business for you. Since we are talking about big opportunities, you talking about expansion plans as well. If you can just give us a sense of what kind of growth prospects do you have in place? Q4 numbers across the EMS space were really strong. Now there's a new player as well. How does the market share work with the competitors? Is it a crowded space now? And versus the industry growth, what kind of growth is Cyient DLM looking at?
So we believe that going forward from FY24 onwards, we will be at least at the industry growth rate. The estimated EMS growth right now is 30% for the Indian EMS companies, but we believe that we will be at least there and most likely higher than that. Having said that, I'll also say that our competition based on what we manufacture is more the global players rather than just the Indian players. Typically, our value proposition and our value add has come because of a globally competitive offering, because of a globally competitive manufacturing solution, rather than just something that's dependent on a particular geography or because it's dependent on cost. Therefore, we believe that the market share right now, all of us are very, very small in the global sense. And when we look at our customers in the markets that we work in, it's actually quite small. And therefore, the opportunity for growth ahead of us is very significant.
Okay. All right. So you are looking at industry level growth of around 30%. So can you talk about the current capacity that you have? You have 6 SMT lines currently with a capacity of 22.47 crores of component placements per annum. How much will it increase by, something that you're expecting in FY24 itself as a capex?
So we don't need to put in any significant capex at the moment, at least from the SMT perspective and from the electronic production. Right now, our capacity utilization between the plants that we have is roughly about 33%. So we have an opportunity to almost grow 3 times before we have to put any significant electronic manufacturing capex. Having said that, there's one element of it which is called box build, which is essentially then to do all the casings and the mechanical components around it. We do need some of that capacity. We do some of that work today. Much of it is done in our facility in Bangalore, or it is a bought out item. We do want to increase our capacity from that perspective, but from a core capacity perspective, we don't need to put in any significant capex till we get to about 3 times the current size is when we'll have to think about additional capacity.
Okay. You know, I was looking at the number of customers you had and your order book as well. So from 47 customers in 2021, it has come down to 35 customers in 2023. But your order book has more than doubled from around 906 crore rupees to 2,500 crore rupees in FY23. That means higher client concentration as well. Is that a risk for you? And what are the order inflows looking like in FY24? What is the idea of order book by the end of FY24?
So we took a conscious choice a couple of years ago that we wanted to focus on the quality of customers, not necessarily on the quantity or number of customers. So if you look at the customers that they have, they are the largest manufacturing innovators in the world today. Some of the companies whose names we've talked about, like a Honeywell or a Thales or an ABB, these are companies in the manufacturing sphere. They are at the forefront of technology, innovation, new products, and spend. So in that context, I would say actually the reduction in number of customers is what's leading to the increase in the order book, because we're able to do a much better job in terms of focusing on the customers, making sure that we get the right capabilities for the customers, making sure that we bring the right engineering to the customers, etc. So that has been one of the reasons why we've been so successful in building up our order book, and we'll continue to focus on that. Having said that, I would say it's not a huge risk for us at the moment with the client concentration, because even if you look at our top 10 customers who are 90%, while for us they're at 90%, we are still a fairly small percentage of their outsourced manufacturing spend. So the way that we look at it is there's a huge runway of growth ahead for us. We can do a lot more with these customers. There's a lot more opportunities. And again, like I said, these are the largest manufacturing innovators. So they will continue to spend. They will continue to create new products. And the opportunities for us will continue to grow. So while there is a bit of customer concentration, I'm quite confident that these are the right customers. So it's a risk that we can definitely mitigate and manage.
Okay, last question before I let you go. Request you to keep it a little short, but you do have 2 segments, B2B and B2S. What is the split here, and what is the higher margin segment here, and what is the margin outlook for FY24? 10% is what you're standing at right now.
So we'll see, we definitely see a runway for growth for margin. There's various things that are going on, and we'll see that continue to increase. Right now, B2P is 95%, B2S is 5%, but the order book points to B2S becoming a much larger part of our business. As we start to execute that order book, B2S will become larger, and B2S, where we have design control, at least to a great extent, that is a higher profitable part of our business.
Okay, thank you so much, sir, for joining us today and giving us all those details. So that is Cyient DLM, very optimistic about growth prospects and margin expansion as well. Of course, we'll keep getting more details on this IPO as well. With that, we'll take your leave on this edition of Midcap Radar. Stay tuned. Mutual Fund Corner when we return.